So were investors right to sell off Netflix last night?
You know, that's a tough call because this is a business. The streaming wars have continued to intensify. I think that businesses were right, or investors were right to sell off after earnings just because of the concern-related subscriber count. Longer term, I'm not so sure that's a smart idea. It might be a buying opportunity come Monday morning or come tomorrow morning anyway.
So in terms of what Netflix is doing, more subscribers, the punters, people like me and Brandy and you, a lot of us like these cheaper subscription packages where you get adverts in them and pay a little bit less. But the money from advertising isn't coming through yet. Do you think it will come, Keith? Good old-fashioned advertising-funded media, and we are part of that.
Well, I tell you what, that is a very sharp question. That is absolutely the crux of the issue. And don't forget why people left cable television in the first place to go to Netflix, because they got frustrated with the advertising. So I'm not sure this model is going to work long time. I've been very skeptical of it. I don't own Netflix. I haven't owned it for some time because I don't like the advertising model. So I think the streaming wars are going to be very, very competitive. There's simply bigger, better fish in the sea. Some of the competitors, for example, Apple is primary, front and center, because they're taking Netflix on in a different way.
I tell you what, Keith, I hope our head of sales here at the Arabian Radio Network, Josh, isn't listening. I don't like the advertising model. It would make him turn in his bed. But let's turn our attention to Tesla now. Again, similar story, really. Numbers are up, deliveries are up very, very sharply. However, the stock was down in after-hours trading because some of the punters are worried that Elon's only driving up revenue and driving up sales by slashing prices and therefore driving down margins. What's your take?
This highlights everything that is wrong with Wall Street today. The punters are taking it down on highly technical matters. They don't understand the bigger picture. This reminds me of Apple in the early days or Microsoft in the early days. I mean, I'm not sure that people who are skeptical or call this a disappointing earnings call were listening to the same call I was. I mean, let's review, Richard. You're talking about $24.93 billion in revenue versus $24.47 billion expected. That's a beat. You're talking about 91% share adjusted versus 82 expected. You're talking about growth in automobile sales of 46%, new capital growth spending, new revenue coming on in the charging network, new supercomputers being turned on for AI. I mean, what is there to miss here? The stock's up thousands of percent. It's just getting started.
And what about Microsoft? It hit an all-time high, closed at an all-time high earlier on this week, $2.7 trillion valuation. Could it go higher if in, say, 5-10 years' time? How high could a stock like Microsoft go? Or Apple, if you prefer, or one of the big tech stocks?
Oh, well, targets. I've been working on these numbers incessantly for the last 72 hours. I think Tesla is looking at another split, $500 a share, 36 months from now. I think Apple and Microsoft are well into the 300s, per the same kind of time frame. So to me, this game is just getting moving. We've created 90+% of all the data in the history of humanity within the last few years. We need computers, we need data security, we need all of the other things to manage that. This genie is not going back in the bottle anytime soon, and that means trillions of dollars will get spent, no matter what the Fed does, no matter what Wall Street does, no matter what short-term earnings focuses there are. Those are the kind of companies that are going to plow ahead, no matter what the politicians think.
Finally, leaving big tech to one side, I was looking at your latest note and a couple of the stock picks that you've got, and you say, and they're quite old-fashioned companies, Pfizer, the drug company, and Lockheed Martin. You say they are very good value at the moment.
Absolutely. And again, this is the intersection of data and old-fashioned businesses. Most of the pharmacological development that's going to occur in the next 5 to 10 years, we're, Richard, right on the cusp of customizable medicine. Think about that for a second. Most of the developments that companies like Pfizer are going to make are not going to occur just in the laboratory with pipettes like they used to. They're going to be scientists running 10, 20, 100 times faster than they used to because they're going to integrate things like big data from Apple and Microsoft and other forms of big data providers. Lockheed Martin, defense, same kind of thing. The world is unfortunately not a very calm place at the moment. So that speaks to the need to produce defense-related armament. And again, here, people are trading both of those companies like they're going to go out of existence. History suggests otherwise.
And finally, a quick word on the bigger picture economy in the United States. From where we are in Dubai, we're seeing mixed messages. On the one hand, we see companies making very strong profits. I think 80% of S&P 500 companies so far have beaten estimates. You've got the job numbers that are still coming in very, very robust. And yet there's talk of maybe 1% GDP growth in the United States. What do you see?
Well, I think mixed is a very apt word, and it's an accurate word because that's exactly what we're seeing here. In this earnings season, we're already seeing that. The companies that are going to do really well, even within the same industries, you're going to see a split. So, for example, you saw JP Morgan just absolutely knock the ball out of the park. You saw Goldman Sachs struggle. You're going to see companies like Apple knock it out of the park. You're going to see lesser choices really struggle as they go through the period. So capital is going to go to where it's treated best. The economy is the same way. We're seeing people plow through this, but at the same time, credit card debt is rising. We've got bankruptcies coming to all-time highs. We've got a lot of challenges in the mom and pop shops, which in our economy are still not working correctly. So it's a very, very tough situation in that regard, even though the stock market continues to move higher.
Finally, Keith, I follow you in social media, mainly for your stock tips, but partly because I love hearing about your motorbike adventures with your wife. Where are you getting the helmets out for this weekend?
This weekend, we're going to go into the Cascade Mountains. We're going to go up above the snow line where we've got lovely views, alpine meadows, beautiful flowers, and all kinds of extraordinary butterflies of all things. It's a wonderful place to watch the sunrise.
I look forward to seeing those pictures, Keith. Appreciate your time this morning. Thanks for staying up late to speak to us. That's the voice of Keith Fitz-Gerald. He's the principal of the Fitz-Gerald Group based in Seattle in the United States.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.